Hey there, you awkward listener, you. Welcome back to the Awkward Insurance Podcast. Ash and I are so happy to have you here, even though she's not here to join us today. And we are happy that you continue to join us on the Awkward Insurance Facebook page. If you aren't already there, please join us. We have a lot in store for 2024. Awkward will be on the road many times this year to many exciting places that you probably wish you were. We're going to bring live streams to you from the Awkward Insurance Facebook page, and I would love to be able to interact with you in real time, find the people that you want to meet, and ask them all of your questions. So go ahead and jump on over there and like us and interact with us. We're having some really fun conversations from time to time. We're also having some woes from time to time when people share what we're struggling with in the industry right now, but that's okay. I am so excited to introduce you to our guest, Brian Thompson. He's repping Arkansas for us today, same place that I'm from, which just means to show that you can't overlook us down here in the good old state of Arkansas, right, Brian?
No, not at all. Not at all.
Do you ever feel overlooked, like when you tell people you're from Arkansas and they're like, oh, do you get that?
Tremendously. Yeah, it's funny you mentioned that, overlook. We recently launched a product in the EU only. As part of that, we got a relatively large amount of trade press. And as they were going through mentioning all of our global offices, they also put, and there's even one in Arkansas. And then there's an editor's note where I felt like the French business publisher had to quantify why they would have an office in Arkansas. He was like, because they have tornadoes and floods. So it is funny, like they felt like they needed to explain why that, it's London, New York, Singapore, Little Rock, Arkansas, Dubai.
I love it. So Brian is a seasoned insurance professional with over 15 years in the insurance industry across various roles, including reinsurance and agency ownership, currently serving, not surviving, or maybe surviving, as the business development manager for North America at Descartes.
No, Descartes. We're French.
No, Descartes. Daggum it. At North America at Descartes Underwriting. He's instrumental in expanding the company's presence, good gracious, what's going on with me today, in the U.S. market through client-centric focus on solving challenging placement problems with innovative solutions. And one of those solutions, or maybe the only solution, is what we're here to talk about today, which is parametric insurance. We've had a couple of episodes on parametric coverage. Have you listened to those?
I have.
Just say yes.
I have.
You have? So what are we going to talk about that's different today?
So we're a little bit different. We are in the commercial space mostly and in high net worth. So we're a little bit different than I think some of the people you've had on in the past. Either a much broader product offering. We're not limited to just one peril. And also we're more of a standalone solution, more so than kind of a bolt-on or add-on you would do to like a homeowner's policy with Sola.
Okay. Awesome. I can't wait to ask all the questions about parametric coverage. I think it's a super relevant topic. It was very relevant like a year or 2 years ago when it was first coming on the scene in terms of personal lines. But I feel like parametric's been around in commercial lines for a minute, hasn't it?
It has. I mean, you go back to the history of it. It's approximately 30, 35 years old. Kind of an event post-Andrew with cat bonds becoming invented. They're kind of the grandparent of parametric insurance, right? But still relatively hard to access unless you were a large carrier, multinational organization, or a governmental organization. You probably weren't buying cat bonds. Over the last 10 or so years, you started to see those kind of come quite a bit more accessible in the mid-market space. And really the last 2 to 3 is when I think you're really seeing them kind of come into just general commercial. Still not real prevalent for small to medium enterprises, but I think that's probably the next phase you'll see over the next few years as the technology gets more accessible, cheaper. The carriers and GAs are able to offer it at a little bit more approachable price point.
Well, you're just ready to get this episode started.
That's what I do, right? I talk about this all day long. And I think, because no one knows what it is. I remember one time I was marketing and a broker replied back like, oh, I don't run ambulances. I don't need paramedic insurance.
Oh my gosh.
So I was just like, you know what? I'm just going to move on from that one. Not even going to try it. But, I have to explain this a lot. So I've had quite a bit of educational background in parametric at this point.
Right. Explain some of like you already did something really funny with the whole paramedic coverage, but explain what you mean by you've already had to educate. Because I know when you and I first met, I think the one reason why we just really hit it off in terms of a conversation after the awkwardness of, I don't know, did I like stare you down? I'm like, okay, now that I think about it, you were kind of giving me Al Borland vibes, and I was trying to decide, if you look so familiar because I watched Tool Time too much as a kid, or if there was something there, and it was really weird. It was like
I know
think I
you.
know
Why
you.
do I
It took
know
us a
you?
minute.
And it's not from insurance, right? I feel like now we need to explain this, but yeah, we had that like locked eyes across the room, and like I know you, and it's not from here. Yeah.
Yeah, it was very weird. But did you feel like you knew me because I'm younger than you, and my experience of how I figured out how I knew you, you would have been older and been like, ah, it's just a kid,
I
whatever.
didn't place the so I guess context. We actually apparently like knew each other loosely growing up, but we didn't know that until a year ago. But no, like I knew of you, like in the insurance space, right? Like I knew you were at the conference, and I was just like, oh, you go see her. And then when I actually like saw you, I was like, oh no, I know you from somewhere else too. And I didn't figure. I think you figured it out.
It took us a minute, and I don't even remember how I ended up figuring it out. But okay, so to add more context to it, it's from when I was like, gosh, I must have been like 16, 17, something like that. And you worked at a movie
I
theater
did.
with my dad slinging popcorn and candy bars at folks.
Yeah.
I was just there for the free movies.
That's why I started working there.
So yeah, we ended up, I mean, it took us a while, figured it out. I think I know you from is the silver screening. So no, we played Looky Loo for a minute. And then once we started talking, you brought up parametric, and I didn't give you this look of confusion. Like I had no idea what you were talking about. So we just started nerding out over insurance.
No, I get excited when I get to say what I do, and the person doesn't go, huh?
All right. So how do you still get a lot of huhs? Because like I said, that was like a year ago.
Yeah,
Are you still getting a lot of huhs? Because I feel like there's been a lot of discussions around parametrics since then.
I feel like the first part of last year and last part of last year could have been a 180, right? I think, going into 2023, yes, very much everybody I talked to was like, maybe they've heard the phrase, but they had no idea. And I think
Yeah.
towards the end of the year, at this point, they had, it was kind of the buzzword last year. I think I spoke at a plethora of conferences, and all of my coworkers did as well. And then we just, all the education that went along with it, the trade press, everything else. I think last year it really kind of exploded up from the summer-ish. And so the second half of last year, I had to explain more so how it worked versus what it is, and just introduce the concept from scratch, right? It was more of like, oh,
Yeah.
I've heard about this. And they would have some kind of, general insight of sort of what it was, but they didn't know how to use it, the best way to, approach it, things like that. But it was very nice to not have to start with like, no, it's not paramedic, it's parametric. Yeah.
So now you're settling in and you're like, thank God I don't have to push so hard. Good gracious. So let's just kind of start there. What is parametric insurance, and how does it differ from traditional insurance?
Yeah. So I mean, at its core, it's very simple, right? I think people maybe expect it to be a lot more complicated, and it is on the back end. But as far as the policy goes and how it works, it's pretty simple. It's pre-negotiated payouts for predetermined events. So, you know, trigger A happens, here's the corresponding payout. Trigger B happens, here's the corresponding payout. Everyone knows exactly what that is going into it. There's no uncertainty around like what's my actual payout going to be, where is this going to come out, what's my deduct, how's it going to impact with my deductible, what's my recovery. All that from the permission from the moment you write the contract, right? And all of it's negotiable.
Right.
It's designed and built for you.
So what's your hot line of business in parametric right now? Like what's the most of what you're selling?
It's cyclone. In the U.S. market, it's hurricane. I mean, that was obviously I think the most impacted from the market changes we've seen the last couple of years. And so that definitively is one of the harder lines to get placed. I cover the Southeast and the Caribbean for Descartes. It's kind of my primary focus. And so obviously having the Gulf region.
Okay, so if it's your top selling line in terms of everything that you just explained, and somebody's still going, I still don't know what parametric coverage is. Triggers, what? Payouts? Okay, let's start with hurricane. Explain like hypothetical claim situation, or maybe real life claim situation. Do you have a real life claim? You can go ahead.
Yeah, I do. So, I mean, a good example, this is actually, it's hurricane. It's a U.S. policy. The risk was in Macau, but it is a claim we had. The event happened, cyclone came through, didn't actually damage the structure, but because of the, they had to shut down because of the event. With parametric, that's okay. We don't have the physical damages trigger required for business interruption. So they were able to recover all of their lost income without suffering physical damage under us. It wound up being around a $15 million payout that we had to them in a matter of weeks. So everyone knew exactly what it was going to be. They knew what the payout was going to be. Part of the delay was just figuring out which account they wanted us to send it to. So we were able to expedite all of that to where they had that immediate recovery post event, and they weren't having to tap into a credit facility or anything else. But going back to your question in regards to triggers, it's very simple. It's we've got a couple different ways we can approach it, but let's say using the cat in a circle model, you've got a 10-mile circle around your location. Hurricane passes through at 8 miles away at 148 mile per hour wind speed. That makes it a Cat 4. That's already designed. Like within 10 miles at a Cat 4 equals 5 million in payout or whatever it needs to be for you. So the moment the National Hurricane Center reports the data, we know what the loss was. You know what the loss. I mean, it's paid. There's no ambiguity about what it's going to be. At that point, it's just how fast can we get this money to you.
So you mentioned no physical damage, but you brought up time element coverage. So is that what it was covering? Was something a time element based, not physical damage or anything like that? Or is it just like, here's a policy. If there's a cat storm within this radius, you're going to get a payment. You can use it for whatever you want.
It's pretty close to that second one. So there is a little bit of kind of a misconception that you don't have to suffer a loss. That makes it a derivative, which is a financial instrument, not an insurance instrument, right? So for it to be insurance, you still have to suffer a loss. We're just not adjusting it, things along those lines. So go back to that claims example. The event happens, you trigger $5 million in recovery. Now, what that recovery is, the insured has to attest saying, yes, I've had this loss equal to 5 million, or if they think it's going to be less, whatever they think it's going to be, and then we pay that. We're not auditing it. We're not asking for receipts. I think there's a lot of misconception about there's a big moral hazard there. We're really not seeing it really across the industry. People are, I mean, it's honest. And the difference is too, what quantifies a loss is significantly different. We don't have this, 7 pages of exclusions, or only these things can quantify into that. It's every economic dollar either spent because of the event or lost because of the event, as well as any physical damages too. All of that can attribute and roll up into that claimed amount. So if it triggered 5 million, you had 3.5 million in physical damages, and you think you've got at least 1.5 million in economic losses. Say you're a hotel, and it's going to take you, 2 months before you start having a good, guest flow again. All of that's eligible towards that. If you want to just, hey, we want to give our employees each $2,500 to make sure that they're able to recover from this operation as well until we get flowing, that's eligible because that's tied to this event. So really any economic loss, physical or just financial, that can be tied to the event is eligible for that. So that's where it's a little bit different. You do have to suffer a loss, but the definition of what can fall into that loss is significantly broader.
Yeah. Awesome. So we've mentioned the hurricane coverage. What other lines of business do you have for parametric coverage at Descartes?
Descartes, yeah. So with Descartes, no, we focus on nat cat perils, right? So anything that's really a natural or catastrophe perils, we're seeing a lot more earthquake. As the wind and hail deductibles are starting to skyrocket, we're seeing a lot more tornado buy down, hail covers for solar arrays, large higher ed institutions. So the peril is, we said, anything that's natural. So again, wildfire, either timber stands or a wildfire at a house, or an earthquake, sort of like movement, flood, either excess rainfall. We've done excess cold covers for energy companies.
Excess rainfall. Explain that one.
Yeah, so it's basically a flood cover. We're just basing it on the rainfall index versus more of a.
But you don't want to call it flood. Is there like
flood? It's just what we're triggering it off of. We can do flood off of satellite-based data, off of river gauges. We can do it off rainfall. A lot of it just depends on data availability in that location. In the U.S., typically the waterways are very well, they've got the gauges everywhere. The USGS does a fantastic job with that. We can find accurate data for that. But let's say it's maybe an area that is prone to flash flooding, but doesn't really have a lot, a nearby body of water that they're worried about. That's more driven by rainfall. And so we can look at historic events, figure out the rainfall indexes that we need to do for that, and kind of work a cover based off just if you've had more than X number of inches of rain over an 18-hour period, it's kind of a sliding scale trigger.
What about your non-traditional triggers of flood? The stuff that's not based on whether like maybe there's a broken water main that meets the definition of NFIP flood. So is that why you call it excess rainfall, because you only want to cover the natural weather event?
So we're natural perils. So I think this is a good point. Saying like we're not a replacement for traditional insurance, right? And I think most people in the parametric space will tell you, if you can find it, it might be a better fit buying the traditional peril. Like if you can find traditional wind, it tends to, people are used to it. It works better. It works better within their existing policies. Where parametric is used is we're a very good solution for a well-defined problem. So that problem who knows where the problem's coming from? It could be lack of capacity. It's got a poor claims history. It's, it's over piers, and so the NFIP won't give you any coverage for it. Typically, excess flow won't either because it's follow form. So you've got these situations that maybe there are some gaps where you can't do it. Then we're a very good solution. So I wouldn't say compare like you were asking about like the water main flood. That's not something that we're going to trigger off of. We're looking for measurable data, typically off natural perils. I mean, in that product I mentioned earlier, it's actually a cyber product. That's only in the EU currently. It's not available in North America just due to some licensing issues and everything else. Maybe we'll get here.
Because we're behind in America.
No. It's just that's before we launched it first. Most of our NatCat capacity is definitely here. I mean, we're a global company, but in the U.S. space, it's probably our most robust offering just due to the access of the data. It's much more robust here in the EU than most of the other countries as far as satellite coverage, reliability of the public gauges, things like that.
Awesome. What does underwriting for parametric coverage look like? Is there an underwriting process? You just started smiling. Is that a good question? Did I ask a good question?
No, I love it. It is a good question because it's definitely different, right? Traditional. I came from a Fortune 300 insurance, carrier. Traditional underwriting, insurance professionals looking at quite a bit of different data than we are. Most of our underwriting is actually they're scientists, they're data scientists, seismologists, climatologists, atmospheric scientists. They're looking at it.
Lolologists. That's
Pardon?
a lot of lologists.
I love it because they're brilliant, but they're looking at when we underwrite something, we're looking at the probability of the peril occurring at that location at the severity you're interested in, right? I don't really care if it's a tent. It can be a building with a tarp wall. It can be built in 1892 knob and tube wiring on a barrier island with half of it falling off into the ocean. We don't care because we're underwriting the probability of the peril occurring at that location, not the structure itself or the occupancy type. We kind of use the phrase a lot, we're risk agnostic. We use all of that to help inform these structures as we're building the trigger points and saying, hey, here's what we think it should trigger for this level of damage. That's correlated to what we think the expected damage should be. We try to make that match as much as possible, but we're not really underwriting the structure itself as far as the pricing goes or looking at these sort of loss histories. We just use all of those data points to help infer the structure. But what we're actually underwriting is the probability of the peril occurring at that location. So it's definitely a different mindset than I think traditional underwriting is, and it's not based on traditional property types, loss run, RMS modeling, things like that.
Interesting.
Yeah.
So you kind of hinted on it earlier as you started going off into parametric coverage not being a replacement for traditional insurance. So let's ask a couple of questions here. Why should an agent offer parametric coverage, especially in today's market? And maybe this will address like what ways are parametric coverage beneficial versus how you shouldn't use it. Because you started going down that road. And a lot of times when a new product enters a market and somebody doesn't take enough time to understand what that product actually is underlying instead of just the marketing and sales pitch, because there's a lot more to insurance than just what the marketing and salesperson say about it. You got to read the language kind of thing. Then they'll jump on board and be like, oh, I'm just going to sling this stuff out, instead of flood coverage, I'm going to do the excess rainfall coverage. And then they don't understand that they're, like you said, it's not a replacement. That client would lose coverage if there was, a water main break that triggered flood or, whatever, that kind of thing. So let's kind of approach it that way in terms of why should an agent offer parametric coverage, what it's beneficial for, and like the absolute, but don't use it for this. Like, don't mistake it for underline and fill in the blank.
Yeah, absolutely, man. So I think it is a good thing. A lot of times when we do these educations, we talk about what parametric is not, right? Like it's not a replacement. And it's not that it's a worse product or a better product. It's just a different product. It's a different approach. It fits really well in certain industry types, certain TIV classifications than it does in other ones. So usually when I said I kind of separate it into two buckets. You've got, maybe 50 million TIV and under, and then 50 million and above. And obviously there's some gray area in between depending on the structures. But let's look at that smaller group first. Usually with those, if they're buying parametric, it's more of they just can't get it, right? It's a condo association that's on a coast that's got hit by Ian last, in 2022, and no one wants to touch it. They can't find cover anywhere. We can provide that cover for them. Or maybe it's they can find it, but the deductible went from $1 million to $7.5 million this year, and there's no way they can fund that. Then we can come in as more of a buy down structure. So we're providing, usually at that point, we'll look at it, maybe we'll attach a little bit lower, right? If we're looking to be, if you look at it, maybe it's not a true layered program, but they want us to be a buy down, maybe we'll attach it to Cat 2 versus a Cat 4 type structure. Or if they're looking for maybe they can find it, but last year they had 15 million limits, and this year they can only get 5. We'll look at more of an excess placement. So now we're attaching in a much higher level wind event to kind of mimic an excess placement. We can also structure it to where it's more of a true excess, but it's easier if we just attach it more, look at the event level versus having any sort of underlying guidelines to be excess, because at that point someone still has to adjust that lower limit, and that kind of violates a lot of parametric of there's no adjustment, immediate payouts, here you go. So usually we'll look at just the triggering points from the event. And I know there's a lot of maybes. We can do this, we can do this, and that's because all of this is basically built from scratch every time. Every time we get a submission, we build the structure and the index and kind of the program around their needs. And so there is a lot of maybes because we can really do whatever we need to do to get to the meat of the problem you're trying to solve.
Yeah. For anyone listening, TIV is total insurable value. You said that a couple of times without context. So I just want to throw that in there. And then as you were talking about, you're building it, like I'm sitting here trying to find, like this is obviously not something that you go into a point of sale system, a POS, and you're like, I want this, and that, because you're building it as somebody calls in. So if an agent's not sure what their client needs or how do you walk them through that process? Because it's kind of like I'm sitting here thinking you don't know what to ask if you don't know what to ask type situation.
Yeah, absolutely. And that's where, we're not just, I think you had Mike on last time talking about business development, and people just bring in the goodie bags, the pins, and that's all they provide, right? We're much more full service than that. Like we hop on calls with the agent and the insured, because I don't expect, we had one marketing visit with you, the agent, to then be able to effectively know how to work this and sell it to your insureds. Happy to hop on that call with you and just be your parametric expert. We provide all sorts of these kind of backstops to help out. Maybe you need to talk to a lender because it's the first parametric they've seen and they're a little unsure about it. So we hop on those calls quite a bit, or board of directors, things along these lines. But as far as the submissions go, it's usually very simple. So usually just your standard property submission, the first page of the core 125s, the statement of values, if it's large enough to have them. If not, just, give me your property schedule, and some sort of 3 or 4 sentences narrative of what you're trying to solve for. Like, why are you coming to parametric? And if you don't know that yet, call me. We'll walk you through it. I'll say, hey, here's the answers we kind of need to move forward with this. In the meantime, we can get the modeling started while you're following up with maybe a little bit more targeted answers before we build the structure. And so, no, it's one of those things we definitely don't expect our, especially a newer agent or broker to come on board with us to be a parametric expert after, 1 or 2 calls. That's what we're here.
I like it. Is there anything about parametric coverage that we're not covering that you would want others to know?
Yeah, so I know we mentioned kind of the smaller TAVs. Let me just kind of touch on how we use it with like much larger organizations as well, because this is when it gets kind of fun and interesting. I say the lower TVs, it tends to be more of they just can't find it for whatever reason. There's something with that risk that's making it hard to place. And so like usually with those, we are more of a replacement. The larger ones are when we start getting more creative. They're looking for, maybe they have the capital to have a much higher self-insured retention, but they don't want to have to touch into a credit facility or take that money out and lose any growth on that. And so they can buy a parametric just to give them that immediate liquidity in a post-event. And we've had one client actually buy us because they were much more worried about being able to keep their employees if there was an event. And so they just literally, it was going to be income to use to keep payroll going, right? It's that BIE kind of cover.
Nice.
But in this case, it was solely focused on giving their employees, it was a tipped heavy industry in the Caribbean. And so they want to make sure they didn't lose their staff to other competitors or elsewhere. So.
Okay, but you say they're interested in using the money for that, but that's not actually part of like the application process. It's not like we want this in case this happens and we're going to use the money this way.
It not traditionally, no, but it helps because again,
there's kind of their reasoning.
They were a hospitality structure, and so they're more impacted by smaller events on the BI side.
Right, business income, by the way.
And so we do, when we know how it's being utilized, like, okay, so they probably do want some cover for smaller events. If they were really focused more on just us being their named windstorm cover, maybe they don't need us to come into Cat 1, Cat 2, because it's a relatively new construction. But they should be able to take a Cat 1 or Cat 2 really directly without suffering hardly any damage. And so normally if they were like, hey, we just need you to be the named windstorm cover, we're not really going to attach that low because there's no need for it, right? It's kind of an extraneous cost that we don't have to charge them. But if it's a hospitality risk, they're looking for it. Like, look, if even if a Cat 1 gets forecasted, no one's coming anymore, they're going to lose income. We're going to not be able to keep them. They may have to find another job, whatever. So they were really concerned about keeping their employees. And so they just wanted the funding to be able to give them basically disaster assistance if they were impacted by a storm, even if it was a much smaller level.
Yeah.
So again, like I said, on these larger ones, that's where it tends to get utilized more as a liquidity play or just a means to kind of fill gaps in their current tower or structure. Maybe they just for whatever reason they want a sidecar for this because we are first dollar coverage and it's immediate. They can use our money to make sure they get the materials and the best contractors in the area.
That's nice. I've really enjoyed the conversation. There's a lot of information here that I think is going to debunk some myths, to be honest, from our other episodes. Because I know in other episodes that we've had, specifically, we've had one around wind and another around floods. Some of those we caught from the InsurTech Insights Conference in 2023 in New York. It did sound like doesn't matter whether or not you have damage, as long as there's an event that triggers, then you get the payment. And then you brought up the fact that some people would see that could be a moral hazard type situation. You don't have damage. What do you do with money? That kind of situation. So I'm glad you brought all of that stuff up. I think that really took care of some misunderstandings, honestly, around what parametric is, could be, or should be kind of situation. So thank you so much for that. Anything else to add?
Yeah. I think in general, it's just, if you have questions, reach out to me or anybody else at Descartes or just in the parametric space. There's it's still kind of an unknown, right? I think people have at least heard of it, but there's still a lot of how to use it. I promise you, even if there are competitors, they're very happy to answer those questions. And if they aren't, call me because I am.
Yeah.
But no, it's a great product. It's going to continue to be a much larger product in our usage as we grow. And as, again, the technology and data availability gets more granular, more readily accessible, I think you're going to start seeing it become much more approachable.
Yeah. Awesome. Thanks so much for being here today, Brian. I'm so happy we had you on. It was a fun conversation. I think a very informative conversation. I really appreciate you.
Yeah, no, it was my pleasure. Glad we got a chance to do it.
Awesome. Toodles, everybody. Thanks for hanging out and listening to another Awkward Insurance Conversation.
If you haven't already, be sure to join the Awkward Insurance Facebook community. We have an amazing group of people on there.
And for more episodes, head over to the National Alliance website at scic.com. Now go forth and be awkward. Toodles!
That's awkward.